In this week's update, the big payoffs starting to roll. Small and mid-cap M&A is a given. Individually, it's just a matter of when. And we're in the sweet spot for multiple industry groups. My name's Garry Davis. As always, this is general advice only. And please remember to like and subscribe to the video. We've had such a hugely successful week that I hope viewers will just indulge me a little bit while I provide a perspective on what we're doing. So as members would know, it's just been really a stunning week. We've been building since late 2022. We've had strong foundations in place, but the first 4 or 5 months of this year were pretty hard to get through. It was a tough period, but we had clear plans, we had patience, and we had an accurate perspective on what was real and what wasn't real. You know, there was a lot of rubbish about lithium, and you just needed to be able to understand the basics to get through that period. But now the big results are starting to flow across all three model portfolios in the Insiders Club. And many of these same stocks have been covered multiple times in Portfolio Analyst as well, because they're some of my highest conviction businesses and have been for some time. But the good news is, and this is the message that I really want to convey, is that there are many more really outstanding results that are still in the process of unfolding. All the elements are there. We just haven't had the price response yet. But the week we've just had and the last couple of weeks demonstrate that price response does come. Now, PA members will know from last week's video that there were many opportunities, many very promising opportunities presented in the US and also locally, along with quite clear entry, exit, trade management plans. And there were also a couple of really vital educational pieces as well. Some really good questions that I think are on most traders and investors' minds. And it's all about, fear of missing out, fear of sudden price falls, all those sort of things. Now, we're right now we're in the sweet spot, which I've been talking about now all year. And now is the time to be building. In my opinion, there is really no time to lose, because some of the price movements that we saw last week, where prices can double in a week, just show that you can miss out a great deal if you drag your feet. Now, Insiders Club members also know that we had a 100% gainer in 4 days last week, and that's been one of my highest conviction core stocks for quite some time. And there are also multiple other strong gains. So, Insider Club members were certainly smiling last week. The PA trial, the Portfolio Analyst trial, is still available. It's $1 for 2 weeks. And you'll get a great deal of insight, you get a great deal of education, and you'll see some opportunities. But frankly, Portfolio Analyst is an opportunity to get comfortable with how I do things, but the real value is in the Insiders Club, because that's where the combination of written reports, video, and the open-ended email support that I provide is helping members enormously. Now, I'm pretty biased, obviously, but I don't think you're going to find a better source of value anywhere in Australia. So hopefully you'll indulge me that little bit of promotion, because it really was a terrific week. All right, let's start with some market perspective. The risk of repeating myself, there's just some amazing opportunities to be exploited in coming years. All commodities will move into significant deficit situations. Some of them are there now. Some are going to take a couple of years. Nickel is probably one of the prime examples because of some dynamics that are happening at the moment. It's going to remain in surplus for a few more years yet. But all of the commodities eventually are going to reach a point of deficit, because the demand for materials in the energy transition is such that nothing is going to be able to keep up. And the other key point is that markets wait for no one. And in the last week, we've just seen some incredibly rapid moves. So you only need to miss by a few days or a week or two, and you can miss out on a huge amount of gain. One needs to develop your plans now and be ready to position on that weakness. If you stand around and wait for the media to ring the bell and tell you that now's a good time, then it's probably a really dangerous time, because most of that surge is probably baked in and it's overdone. So you've got to get ready in advance. Chasing hot sectors is just a recipe for disaster in this kind of market where prices are moving quickly. Now, the other key perspective is that China economically is still struggling. Trade is weak. Inflation is not an issue. In fact, deflation is not a ridiculous concept for China. Bank lending is weak. But I guess, the good news out of all this is that they're free to stimulate, and that's what they've started doing. But the other bright spot is that new energy vehicles sales are strong. So that's the bright spot, and that means increasing commodity demand. So that's the overall market perspective. Let's start with America. The S&P whacked on 2.6% across the week, and as we'll see from the money flows, it's definitely continuing to support the bullish case. Perhaps in the short term getting a little bit too hot in some sectors like technology, but it's good to see that breadth is now less of an issue. We're getting more and more parts of the market now joining in. So that's a positive for the American market. The US dollar was a bit lower again, down to 102. The yield was up again slightly, 3.77 on the 10-year. The VIX also down, so the really just continuation of the trends that we've seen, down to 13.5, which is really, in the context of the last 3 years, is very low. You go back to 2019 and we had VIX levels that were lower than that, but that's quite some time since we've been down at this level. And the 10-year, 2-year spread is negative 0.93, so still screaming recession. Let's jump in and look at some charts. We'll start with the NASDAQ. The NASDAQ was pretty excited last week, got even more excited in the week just gone. A little bit of a turn down on Friday. Now, it was options expiry in America, so the volume was up. So you've just got to look at that and not place a lot of importance on it because of the options expiry. So we'll get more of a feel for what's happening with the NASDAQ after the first 3 or 4 days of trading next week. If we look at the Russell 2000 for small caps, quite a nice move over the last couple of weeks. So I drew attention to this on the 2nd of June, so 2 Fridays ago, when it made this very, very concerted breakout, and it went on with it in the subsequent 2 weeks. So that's good to see that the breadth is now coming back into the market. That makes the overall index advance more sustainable. Let's look at the S&P. Look at it on a daily, or this is the equal weight S&P, so it's moving up. So that's where the market cap doesn't dominate the chart. And this is the raw S&P. So this is obviously heavily influenced by the big tech stocks. Let's look at where the money flows are going. No real change. NASDAQ versus the S&P, slight turn down Friday, but this is an enormously powerful run up that started at the start of the year. Semiconductors versus the S&P, also screaming off the map. There was some profit taking in semiconductors on Friday, but there needed to be. Semiconductors are just getting too hot. So they need a bit of a consolidation. They need a bit of cooling off, but I think there's still a lot of bullish times ahead. And if we look at this sector chart, all the main sectors, this is over the last quarter. Technology, communication services, consumer discretionary. So they're all the aggressive parts of the market. And over the last quarter, you can see they've outperformed finance, materials, energy, healthcare, and staples, consumer staples, by a considerable margin. So let's zero in and see if that is being sustained. So let's go in from the last quarter to the last month, and you can see we've still got the same order. A little bit of a change in the strength, but it's still pretty much the same order. Materials picking up in the last couple of weeks, but otherwise everything else remains in the same order. So that folks is the US market. Let's look at the dollar on a weekly chart. So quite a significant move back to the downside, and the Australian dollar, of course, was the inverse of that and moved very positively to the upside. And iron ore being strong, oil picking up a bit, those things all sort of helped. Stimulus in China, that all helped sentiment towards the Australian dollar. Okay, let's just have a look at what happened in Australia. So 68.03 is where our dollar finished. Our index added 1.8% across the week. Not sure how things may open on Monday. Last week, Infotech was the big winner in Australia, especially small caps in the Infotech sector. Healthcare got whacked big time with CSL. CSL was down about 7-8%. On a report where the main problem is currency headwinds. The business itself is still going along very nicely, and guidance excluding currency headwinds is still really solid. So that certainly had an impact on the index. Now, the mergers and acquisitions activity for commodity stocks in 2023 is already many multiples of what we've seen over the last 10 years, according to Firetrail. So, that is a theme that is really now starting to kick in massively. And and that's just in 5 months. So the first 5 months of the year, the M&A activity is many times what we've seen for entire years over the last decade. So very, very strong signs there. And it's no surprise, because when you look at it, it's cheaper and faster to buy someone than to develop. Go out and have to do all of the exploration, all of the regulations, and all of the development activities. It's just quicker and cheaper to do it that way. But of course, all that does is it doesn't do anything for supply of commodity. It just rearranges the deck chairs. So commodity prices have to rise for two reasons. One, because demand is outstripping supply, and so that's just natural laws of economics. And secondly, the price needs to go up to incentivize the further investment, because the marginal resource requires a higher commodity price to be developed, or to justify being developed. So whichever way you look at it, commodity prices are going to move higher over time. They're just going to do it in a different order. All right, precious metals was down $3 to 19.58. So gold is still struggling to achieve that momentum to break out above 2100. A lot of it at the moment is about the perception over interest rates. So the perception is that the Fed is on pause and may or may not increase rates further after a pause, but we're still seeing increased rates in other parts of the world. So the perception is that rates could go higher, and that, of course, is not good for gold because gold doesn't provide a yield. Now, when you translate slightly lower gold price and the higher Australian dollar, it resulted in a fall in Australian dollar gold price. So we're up over 3,000 a few weeks ago. Now we're down under 2,900. There were plenty of robust local moves last week, though, despite the weaker metals price. Part of that is because of this M&A activity. So what happens is that the stocks that are perceived to be the primary targets, so they either have a resource or they have strategic geographical value or something that makes them more of a target than other stocks. And it's those ones that start to attract a premium. There's no takeover offer yet, but the market starts to price in the fact that one could be coming. And I think that is starting to assert itself in the Australian market. No particularly fabulous moves at the moment, but I think now is the time to be positioning in that area. All right, let's just have a quick look at the gold charts. Sorry, that's the wrong, didn't put the right code in there. XAU. There we go. So there's gold on a weekly chart. So fair range. The lows got down to 1925 before we bounced a bit. So that's the weekly chart. The good news is we're closer to the top of this range, which has been in place now since 2020. So the range is from 1660 to 2080. So we're right up the top, but it's just it's not getting that momentum. And if you look at that on a daily chart, you can see more clearly that we're just not building that momentum to follow the move that we got here on the 4th of May. So it's only about 6 weeks ago that we set new all-time highs and then immediately lost it. That's what's so frustrating about the gold price. Okay, so that's precious metals market. Looking at other commodities, copper moved higher, 387. Nickel also higher to 1038. Crude oil gained $1 or so, 71.44. And as I've been saying all year, there's an opportunity in the energy sector. Now, according to Rystad Energy, the exploration spending has been on a sharp downhill trend since 2015, which is happens in conjunction with the whole climate change agenda. So exploration spending is moving sharply lower. So therefore, discovery has plummeted. But at the same time, overall energy demand continues to rise. Now, some of that is coming from renewables, but a lot of it is still coming from fossil fuels. So that's the reality. And the other reality is that, and this hasn't really dawned on politicians or the media yet, that you just can't turn on the renewable energy supply quickly enough to replace the gap. It just can't be done, and that penny hasn't dropped yet. But there's a lot of well-constructed, well-thought-out reports coming out now from industry experts that make it very, very clear that the transition to renewable energies is just not going to happen with the speed that people expect it to do. And so therefore the pathway has got to change. This balance between replacing existing fossil fuel power generation with renewables, the pathway's just got to change. Otherwise the lights go out. That's pretty much the long and the short of it. And I think everybody is just sort of nodding and expecting that the energy transition by 2030 is going to happen. Well, it's not. So it's going to be very interesting to see how that balance point is going to be met. In lithium news, not much, nothing new, but the price action continues to improve. There's the spot copper chart, so quite a nice rebound from just below 360. And if we look at the 6-month warehouse levels in the LME, they've come off from 100,000 tonnes down to 80,000 tonnes, so that certainly helped the copper price. And there's nickel also rebounding. All right, wrapping it up, now's the time to get set in the market. Not necessarily to be, just rushing in and buying, but to get yourself organised, get your plans in place, and get set for what is just a fabulous opportunity. And I've been talking about this since 2021, about the fact that the rest of this decade was going to be volatile, but it was going to be potentially very, very significant wealth builder. But look, you've got to do your homework. You can't just front up and buy whatever's being tipped or in the media. In my view, the majority of stocks across the market are dangerous, even in the commodity space. As bullish as I am on lithium and copper and graphite and rare earths, the majority of stocks in that area are dangerous. They're poor quality. A lot of them almost exist to pay the salaries of the executives. So there's just so much danger even in a hot space. And of course, in the non-commodity area, the same applies. The overall markets have very significant risks. I don't need to, tick off all the things that could go wrong. So there's significant risk in the market. So the message that I keep giving members all the time is just let's control what we can control, because we are in control of most things to do with our investing. And we can't control what happens with individual stock prices from time to time. But the way we construct our portfolio, you certainly can. And most parts of that you are in control of. So that's the message for this week. Portfolio analyst last week, I got a lot of very, very good feedback, presented numerous opportunities in America and in Australia, stocks for the watch list, stocks that I think are going to pay off really, really well. We also got a question about what to do when stocks are roaring higher, whether you're in them or not in them. How do you play that? And that, I'm sure that is exercising many minds at the moment. The fear of missing out is kicking in. But there was also a very good question about how do you manage the fear of sudden price falls? If you got beaten up badly in 2022, as many people did, because 2022 was one of the toughest years of the last couple of decades. So how do you manage the fear from the experience you had in 2022? And I'm sure a lot of people listening to this video can identify with that. So I gave out some very clear thoughts on how you organise yourself to make it easier on your psychology. So that was Portfolio Analyst last week. And of course, as I mentioned earlier, there's a 14-day trial for $1. Gives you a chance to look at how I do things, the perspective that I have on various parts of the market. So very exciting times. If you want to know more, there's information on the website. My email address is there, and I'll be back with you next Sunday with as much enthusiasm as I have today. Cheers.